So we want to get back to our discussion of banking. Same box with the dollars coming in, the dollars flowing out, the sources of funds, and then the uses of funds. What do bankers do with those dollars after they get them? Primary reserves, secondary reserves. These are both liquid assets. The primary reserves earn no interest, so bankers, little or no interest, so bankers do not like to hold primary reserves for the most part during ordinary circumstances. So after they get all the liquid assets they want to hold, then they're very happy to move any other dollars that come in down into this third category of loans. And they do that because loans are the assets that earn the highest interest rate and the most profitable category of assets during normal times. Okay, and normal times is what banks are making policy for. We talked about different types of loans last time. We talked about mortgages or real estate loans. What did I tell you? This is about 60%, didn't I say, of loans? It's not 60% of assets, but 60% of loans. Loans themselves are about 2/3 of total assets, 65% of total assets. And then of all loans, mortgages, real estate, a very big percent. You know, this didn't used to be so big, but what made it get a lot larger was that back in the early 1980s, I think at the time, the biggest real estate lender were savings and loans, and we went through a savings and loan crisis where hundreds and hundreds of savings and loans failed. And then that kind of gave the savings and loan industry a bad name, at least at the time, and so a number of other savings and loans changed their charters, went over and got a bank charter. And so basically the savings and loans that failed were no longer able to make home loans, and so then people that wanted to get a home loan started going to banks instead. Banks had the money because when the savings and loans closed, then people didn't put their savings in a savings and loan, they put it in banks. And so the funds shifted from the failed savings and loans into the banks, and then people borrowed their money for the homes from the banks. And then, as I say, the other thing that happened was some savings and loans just shifted over to bank charters. So they had the deposits and they made the loans. And so at that point, the banking industry became the dominant lender in the real estate market. But this is not only residential real estate, it also is commercial real estate. And we talked about those things last time. A second category of loans, C&I, remember what that stands for? Commercial and industrial loans. Let me see if I can tell from my notes how far we got into that. I think not real far. This is about 20% of total loans, or about a fifth. And this is to finance, you remember the terminology, ongoing business activity. And so what I'm saying is this is for operations. These are not loans to buy assets such as a building or a factory or something of that nature, a parking garage, shopping mall, office building, okay? So anyway, this is for ongoing business activity. A lot of it, not totally, but a lot of it, we're talking about inventories. Inventories in stores, inventories in car dealerships, motorcycles, and so forth. And then also to purchase other types of inventories, materials. Like if you were manufacturing, let's just say refrigerators, you might go out and buy a bunch of steel and a bunch of motors and things like that. And these are not finished products. These are materials that would go into production. But you could borrow money, go out and buy an inventory, which is what I'm talking about here, of maybe $1 million worth of stuff, all these materials, set it over in your warehouse, and then bring those out and assemble refrigerators and sell the refrigerators. And then when you do that, you pay off the loan for these materials. And so it's not just retail inventories that we're talking about here. Okay? And that is mainly what we're talking about here. Let me talk about the interest rate. We've already used this terminology before, but These loans are priced, usually, not always, priced off of the prime rate. Remember what that prime rate refers to? The general interpretation of the prime rate is this is the interest rate banks charge their best business customers. And not best, they're buddies for golfing. They're low risk business borrowers. Okay? And so bankers will have a formula to set this prime rate. We'll talk about that in just a moment. And then, as they make loans to other borrowers, other business borrowers that are not their safest, then they'll just have in their formula prime rate plus 0.5%, prime rate plus 3/4, prime plus 1 or 2 or 3 or whatever. But it'll be prime plus something. And then that something depends on the amount of risk. Okay, and so if you have a small company and its sales they fluctuate a lot over the course of the year or the business cycle, they might be paying prime plus 4 or 5%. And if you have a really big, safe company, they may be paying prime. Now, let's talk about this prime rate itself. First of all, every business or every bank sets its own prime rate. If I own a bank, I get to say my prime rate is 4% or 12% or whatever I want. Okay? But what we find is this. Even though legally every bank can set its own prime rate, what we find is this, is that the leading banks, the big money center banks, and a few of the very largest regional banks, they have their prime rate and then the others follow the leader. They don't have to. That's just what happens in practice. So each one of those big banks, the reason they are setting a prime and the others are following the leader is in order to set that prime rate at the right level, or if you don't set that prime rate, I should say, at the right level, then here's 20% of your loan portfolio, and we are talking about 20% of trillions of dollars. Okay, so we're talking about, I don't know, maybe a couple $1 trillion here. If you don't set the prime rate at the right level, then you've got your loans priced wrong, incorrectly. So anyway, these big banks have got a staff of economists and financial experts, and they are studying these credit markets all the time, and then they say, hey, here's what our prime ought to be. And so then the other banks, the smaller ones, the community banks and so forth, are sort of piggybacking on all that expertise and saying, hey, here's what Citibank is doing, here's what Bank of America is doing, and so forth. We'll do the same. Here's what Chase Bank is doing. Okay, we'll do the same thing and use their expertise, no charge. Now, they have these research departments that are doing a lot of work. Several years back, Citibank had a formula Citibank is one of these money center banks that we talked about before, one of the 2 or 3 largest banks in the United States. Okay, and I'm not saying they all follow this formula, and I'm not even saying, I don't know what Citibank does today. They can change that anytime they want. But this is a formula they used to have, and it will give you some idea of the logic that goes into this. They had a formula for their prime rate, and here's what they did. They said the prime rate at that time was equal to the interest rate on 90-day CDs plus 1.25%. Now, the CDs, certificate of deposit, this was a source of funds for Citibank, right? You remember banks have sources of funds, deposits, transactions deposits, non-transaction. Of the non-transaction, CDs, certificate of deposit. And so a vast amount of money is brought into the bank through these CDs, and then the 90-day, we're talking about a 3-month deposit. In essence, here's what Citibank was saying. Hey, how much do we have to pay to get dollars? What is this source of money? What is it costing us? So here's the cost of funds. And then they said, hey, let's mark that up by 1.25% markup. And that's how much we will set our prime rate at when the dollars go out to our best business borrowers. And then for other business borrowers, it'll be prime plus 1 or 2 or 3 or whatever. And the fractional rates too, of course, prime plus 1/2 or 1.5. Okay? So anyway, what I'm saying to you is this, is that prime plus approach is what is used almost always with C&I loans. Okay? And then as we see interest rates going up on deposits, we're going to see interest rates go up on these loans. So another thing I'm telling you is this, when I say the prime plus, I also mean this. These businesses don't go down and say, oh, well, I want to borrow money, and then the banker say, okay, 4%, and that's it. What they say is, you know, our formula tells us 4% today. If the prime changes, your rate changes. There is no locked-in interest rate on this. Okay? And when can the prime change? Anytime. They really took an average on this. It wouldn't just be that day's 90-day interest rate. But anyway, the point is that these business loans are not at a fixed interest rate. Most mortgages are at a fixed interest rate, residential mortgages at a fixed interest rate, but these loans are very seldom at a fixed interest rate. You just pay whatever market conditions demand. Any questions about this? Let's talk about a line of credit. And I'll come back and talk about this a little bit more before we get done with this topic. Sometimes what businesses do, and now we're still talking about C&I loans, commercial loans or business loans. Sometimes what will happen is a business manager will go down to the bank and say, hey, I want to talk to you about a loan. A banker says, have a seat. They talk a little bit. I'm thinking about buying, I don't know, I like to say delivery trucks, but I'm thinking about buying a warehouse, or I'm thinking about this or that. And I want to go out and do some negotiation. I don't have the delivery truck or the warehouse. I don't have it picked out right now. But I think I'm going to do this. And so what I'd like to do is talk with you and say, would you make me a loan if I get to that point? And so then what the banker does is says, have a seat. We'll talk this over. And after they talk, and there's a lot of, we'll check into your credit reports and all this kind of stuff, then the banker might say something like this. Here's what we'll do. I will promise to lend you, let's say, $500,000 anytime you want. Up to $500,000. And here will be, you know, and it might be prime plus 2% or whatever the number is. Here's the formula. Here's how we're going to set the interest rate and so forth. But you've got a line of credit of $500,000. Another business might be $5 million. It depends on the business and their needs. Another reason to do this, you might not even be saying, oh, I'm thinking about buying a delivery truck or a warehouse. You might just say, you know, if things kind of get rough over here at the business, we're kind of going into a difficult time. If things just get rough, I may need some cash. For what? I don't know exactly. But still, you can use a line of credit. You go to the banker, you say, I want to talk to you, and this is a pre-approved loan, essentially. So you go in, you negotiate the loan, everything is worked out, the banker commits to making the loan, but just not today. And then they say to you, okay, now that we got a deal, sign all this paperwork, all you have to do is write a check. And as soon as you write the check, we'll honor it. This line of credit, it's not, but it's a lot like what we consumers would think of as just a credit card, right? With a credit card, you fill out a bunch of applications, and then they say something to you like, we approve you up to a certain amount, and then anytime you want to use a credit card, you do. I personally, I've got a credit card, and it's a line of credit up to $300 anytime I want to use it. $300, quite a bit, huh? That shows their confidence in me. Anyway, and so then, what happens? You go out, the terminology is draw down the line, but a business can draw down their line of credit by, let's say, go out, write a check for $100,000, pay that off if they want. You know, at whatever rate they want, they still have that line of credit there of $500,000 for some period of time. Okay? And so this provides flexibility to these businesses. They always know they got some liquidity they can draw on. And this is very common. And it's not just big businesses that do that. Small businesses get lines of credit, and so do farms, farm managers, and so forth. Even small farms a lot of times will have a line of credit. For people, not only do we have credit cards, but we have something called like a home equity line of credit. And a home equity line of credit is the same thing, where you pledge your house as collateral for the loan, then they give you a checkbook, and then anytime you want the money, you write a check, and then pay it off whenever you want, or keep it for a longer period of time. And so, anyway, this line of credit thing is something that banks do quite a bit of. And so when we're looking, not just we, but bank regulators, when we're looking at those banks to see are they safe or risky, it might be that when we look at the loans they have, we say, pretty safe. But you know, if they've promised to lend a bunch of money, they're committed to lend a bunch of money to people and companies, it could be that without any more decisions being made and no longer under their control, somebody just with a line of credit goes out and writes a check, and now all of a sudden the bank's made a risky loan. And the decision was made months ago to do that. This is part of, generally, sort of a continuing relationship between a business and their banker. So you just go, hey, I'm doing business with you. The business would say it to the banker. I'm doing business with you. I'm a regular customer. This is something I need. I need a source of liquidity. Big businesses, if they need money, a big business can go up and print up some bonds and sell the bonds. But if you're running a small business, you know, that sales are $500,000 or $1 million or $2 million a year, you don't really have access to going out there and printing up bonds all the time. And it may be that things are a little bit tight. It's a small business after all. So at times, business is not great. And so then it's nice to have that line of credit so you're not always worried about, gee, I wonder if I could get the money if I need it, you know, Wednesday, 3 months from now. And so this way you would always know the answer to that. So anyway, any questions about this? A third kind of loan, third category of loan, is a personal loan or consumer loan. Personal and consumer loans. And this is about 10 to 15% of all loans. You can see, and we're not going to get into much detail after this, what do we have, 60, 80, 90% of loans or more with these three categories. Okay. Now, these are loans to people. Go figure. Now, people get loans from other places, not just the bank. A very common source for people to borrow money is credit unions. And millions and millions of people have credit union accounts. And credit unions are really set up to sort of provide, to hold the savings, usually savings. They have little checking accounts, but usually the savings of people, small savings usually. And then a few $1,000s would be typical. But anyway, and then to make small loans to their members. Okay? But bankers do some of this as well. The big category of consumer lending by banks is credit cards. Okay? And so when you go get a credit card, Visa and MasterCard are the most common, not the only ones. But we've got these companies, Visa company, MasterCard company, and they are in the business of putting on the commercials on television and getting the readers out, you know, the card readers out in each store and each restaurant and things like that. And they do that sort of thing. But the actual lending, that is to say, if I go to the store and I, you know, scan my credit card, swipe it, the credit card, at that moment, that retailer gets paid, not at that moment, but the retailer is going to get paid, and I don't pay my bill until, well, in my case, several years from now. But you don't pay your bill for a few weeks. What happens in the meantime? And the answer is basically somebody else steps in and pays that retailer on your behalf, and you pay that somebody else. And that somebody else is making a loan to you. They don't hand the money to you, they hand it to somebody else and then send you a bill. And who is that somebody else? Well, it's really a banker. You're really borrowing the money from a bank. Okay? Citibank, for example, I've already talked about them a couple times, they issue millions and millions of credit cards. And this is consumer loans for them, personal loans, consumer loans. Okay? So, but that Citibank card says, I don't know, it's got the little MasterCard logo on it or the Visa logo. Okay, and you might think, oh, look, Visa loaned me money. No, they didn't. Visa issued you a card, which they licensed to Citibank. Okay, and then you get 5 applications a month for a new credit card come into your house. Anyway, so banks are making a lot of loans to consumers through the plastic, the credit cards. Interest rates, reasonable? Yes, no? Kind of high, aren't they, on credit cards? Why? Well, one of the reasons why is there's kind of a high default rate on those. Anyway, very often, not always, but very often, these personal and consumer loans are to finance the purchase of consumer durable goods. Now, credit cards you can use for anything. Lunch, right? You can just use a credit card anytime you want. But other than the credit card purchases, or loans, I should say, at other times we go to the bank and say, hey, I want a loan. I, a consumer, want a loan. You don't actually have to, like, label yourself, I, a consumer. They know you are a consumer. But when you go to the bank and say, I want a loan, what for? A car, a boat, a motorcycle. And so that would qualify as a consumer loan or a personal loan, and it's to purchase durable goods. Durable goods, long-lasting goods, big-ticket items. Some people have enough cash to go out and buy a car, but most people don't. And so most people are going to go to the bank or a credit union or a savings and loan and so forth and get a loan. And so this would include that. So we're really talking about the durables and then also the credit card debt. And then I mentioned the home equity lines of credit. Home equity loans are secured by your home, but it's just a loan to you as a person for whatever you'd like to, and that's really what we call a consumer loan. Does everybody know what I mean by a home equity loan? Let me give a simple example. Let's say you buy a house, it's a $100,000 house. You put a $20,000 down payment, so you borrow $80,000. Okay, the years go by, and as the years go by, you pay off some of this loan. And so you started off with an $80,000 loan. As the payments are made, maybe you've got this loan down to $60,000. You paid off 20. And then also, what happened was, over those years, the value of the home very likely went up. Now it's a $140,000 home. Hypothetical numbers. But anyway, the point is this, is if you've got a $140,000 home today, and you've got an $80,000 debt against that home, then the difference between these two things is $80,000. I don't really mean for that to be the same as that 80. Let me change this amount. 50. You still owe 50, and now you've got $90,000 of what? Of equity in your home. Equity ownership. If it's a $140,000 home and you owe 50, then $90,000 is what you would keep if you sold that house and paid off everybody you owe. Oh, I get $90,000. That's my equity. Now, you might say, I feel good, I got $90,000 worth of equity, but it's tied up in that house. I can't get it. And the banker says, yes, you can. We got a special way for you to get that. We will make a loan to you, a home equity loan, and we will use this $90,000 as collateral. And since the home is collateral, pretty safe loan. From the banker's point of view, it's secured by good collateral. So here you go, pretty good interest rate. in addition to being pretty good interest rate, since the loan is secured by the home, then on tax day, April 15th, when it's time to report and pay your taxes, report your income, pay your taxes, you get to deduct any interest on a home equity loan from income. And so if you paid, let's just say hypothetically, we use a number here, let's say you earn $50,000, then you've got certain deductions and exemptions and things like that, and let's say you've got a, I don't know, $40,000 taxable income. You go out and go get a home equity loan and pay maybe $2,000 worth of interest on that loan. You get to subtract that $2,000 in interest on HELOC, home equity line of credit. And then your taxable income is just $38,000 now. And so not only do you get a good interest rate, but you also don't have to pay taxes on that part of your income that is paid on that particular loan. And that's another benefit. Is that a lot? It's not a lot. How much would it be? If you paid $2,000, then if you're in the, we'll say 33% tax bracket, both of federal and state income, then a third of that, $666, will be how much you would save on your tax bill. Pretty significant. A third of the interest. And so that'd be like, oh, I'm paying 6%, but after my tax saving, I'm only paying 4%. So that's kind of a nice feature. And so if you're borrowing money, you know what a lot of people do is they say, I'm not going to go down and get a car loan. If I get a car loan and they say 6%, I pay 6%, end of story. If I go get a home equity line of credit and pay for that car, they say 6%, but then I get a tax break, 4% after the tax break. And so this is a very desirable kind of loan. And also, by the way, the car is secured by the car. The home equity line of credit is secured by a home. That is better collateral. You're very likely to get a better interest rate. It may be that the car loan's 6 and the home equity line of credit be 5.5. So you're going to save something there on just the interest. Anyway, here's the problem we've run into in recent years, over the last decade. People said, oh, I bought a $100,000 house. It's now worth $140,000. I'm going to go get a loan. And then they go get a loan, and then the value of the house goes down to $100,000. And then they say, oops, I was borrowing against equity that went away. And then the banker says, oops, we were lending with collateral that no longer exists. And so normal times that doesn't occur, but if you get into a situation when the housing market's weak, then these home equity lines of credit are riskier than they appear. And then people go, damn, I can't believe I was borrowing, because the thing that drove them to borrow is to say, I got $90,000. It's just locked up, but I'm going to borrow against that. I don't feel bad. And then all of a sudden, if this happens, they say, oh, I got $50,000. Oh, I wouldn't have borrowed so much if I knew that my net worth wasn't as much as I thought. So anyway, a little bit of that has happened lately. So anyway, we have these various types of consumer loans, personal loans, and bankers are into that pretty big, and it is the third category of bank loans. Other kinds of loans, let me do a little erasing here. We're not really going to get into. Other than just to kind of tick a few of them off. Other. Interbank loans. That is to say, loans to other banks. Farm loans. How about this one? Loans to investors. When I say interbank loans, I really meant loans not only to other banks, but savings loans or credit unions and so forth, but other financial institutions. Loans to small governments, local governments. occasionally. Okay. Anyway, all of these add up, all of the others. Let's go through there. 60 and 20 is 80, and 10 would be 90. So the most this could be is 10%. So we're talking 5 to 10% of bank loans, or for all these other categories. And many of the features of these other loans are kind of like what we've been talking about. Questions about this? Now, so 4 is kind of interesting.
Is that 5 to 10% of
5 or 10% of all loans are in these other categories. And of course, it can change. It really depends on what's going on in the economy at any point in time. There are certain times when you say, gosh, I just don't want to lend nearly as much to consumers, and I want to do more lending to big businesses or whatever. So I'm giving some broad averages. So the bank has got all the liquid assets it needs or finds desirable, both in primary and secondary reserves. Then they say, we're going for loans. If they could, after they get their liquid assets, if they could, they would just make everything else as loans. That's the end of the story. But they want to get that money back. And so really what they're going to do is make all the loans they can consistent with the concept of being repaid. And generally what that means is they say, that's it. And the next guy comes in and says, I want a loan. They go, no. So then there's still money left over. What do you do? And so there is a residual here. The residual is just this overflow of any more dollars that come in. And we've got liquidity, and we're making the most profits we can off of making loan, loan, loan. Whatever's left over, it goes into this last category. And these are called investments or securities. Now, there were already some short-term securities up here in the secondary reserve category. And really what we're talking about here are bonds. We talked about securities as secondary reserves. The secondary reserve securities were short-term, very liquid. And so what we're talking about here is medium term. I'll say medium and longer term. What's this curve called? Anybody? Bueller? You know the movie? Ferris Bueller's Day Off. Pardon me? Yield curve. Here's what that yield curve tells me that is of interest to this. Here's a secondary reserve. They're short-term, liquid. And they also pay a low interest rate, or earn a low interest rate. And so the banker is thinking this, you know, I made all the loans I can. I could hold more secondary reserves, but gosh, they don't pay much interest. Depends on the year, but maybe 1, 2, 3%. Again, it depends on credit market conditions. Those rates are very low right now. So then the banker says, you know, I think what I'm going to do, since I can't make any more good loans, and I don't need any more liquidity with a low interest rate, I think what I'm going to do is come out here and acquire these, what I call them, investments. These bonds of longer maturities. And boy, it would be seldom that they would say 30-year bond. It's possible, but 5 years would be kind of common. And then they're going to get a higher interest rate, right, or a higher yield off of those types of assets. So anyway, what are we talking about? Let's just make a short list. Treasury, notes and bonds, Just a little bit of review here. Treasury notes have a maturity of 2 years up to 10. Treasury bonds have a maturity over 10 years up to 30. So mainly what a banker would be interested in, for reasons we'll come back to, be Treasury notes. But Treasury bonds qualify as these investments. Okay. How about this one? Corporate bonds. Investment grade bonds, no junk bonds. And you remember the investment grade, AAA down to BAA, and then not beyond that, no BA and so forth later. Right? This is the Moody's classification. With Standard & Poor, we go that for to triple B and no double B or lower. Bankers got to lay off of those. They don't have to. The thing is, if they start buying these lower quality, higher risk bonds, they have to hold a lot on reserve for those, because it's assumed that there'll be a considerably higher default rate on those. And so then bankers just say, that's not worthwhile. So they're buying these higher quality corporate bonds, not a vast amount, but they're doing it. They buy municipal bonds, sometimes munis, or sometimes just municipals would be the terminology. But municipal bonds are issued by government lower than the national level. So they're not treasuries, they are cities, states, counties, hospital, sewer districts, not hospital and sewer, but hospital districts, sewer districts, school districts, issued by government. You ever drive out on like the highway and you're just driving along and just out in the country, you're on the interstate, and you look off and kind of in the trees way back there, maybe a half mile back, you see a water tower sticking up back there. And then there'll be letters up on that water tower, and there may be something like this, PWSD. And you go, okay. Well, that P would be for, I don't know, you just named a town. Pittsburgh, Pulaski, whatever, Pomona. And then at WSD, Water and Sewer District. And what happens is the people living out there in the country, they say, you know, just because we live out in the country, we still like to have a little electricity, still like to have some running water, still like to have some sewage treatment. And so what they will do is people out in that area will get together and form a power, water, and sewer district. Sometimes it's just water and sewer, you know, it's whatever they want to form. But they form their own little, it's kind of like a government. Now, they don't have a mayor and stuff like that. They're living out in the country, but they've got their own little government, and they say, hey, let's get together and generate some electricity, basically bring water to us. We'll run lines out to everybody's house. We'll treat the sewage and so forth. And so they say, oh, well, we have estimated, and for, you know, these 200 homes or something like that, it's going to cost us $6 million. And then what they'll do is print up some bonds. They'll go to an investment bank and say, help us out. And they'll print up some bonds, and they'll sell those bonds to investors. And now, every month, they're paying a water bill and a sewer bill and so forth, an electricity bill. Every month, they're paying the bill, and partly that's for the water and the sewer and so forth, but partly it's to pay interest and to pay off those bonds. Well, who's buying those bonds? Well, gee, banks. This is kind of like a bank making a loan to those people living out in the country for their power, water, and sewer. But they don't actually make a loan where it's negotiated. It's done in this more impersonal way of, in the credit market, or in the bond markets, the bank can go out and just buy those bonds. So, when you're driving along and you look out there in the country and there's this little water tower with those big letters on it, what's going on there is there's kind of like this financial market aspect of what's taking place, and also this kind of governmental aspect of what's taking place. Okay? You remember that one desirable thing about these is if you own these bonds and you're earning interest on those, it is not taxable as income by the federal government. So if you earn $10,000 in interest and you're in, I'll just pick out a number, the 25% tax rate, You say, oh, look, I got $10,000 worth of income. I don't have to pay federal taxes. That's $2,500 of federal taxes I don't have to pay. And so the people who are in the higher tax brackets find that even more desirable. People in lower tax brackets say, you know, if you're in like the 10% tax bracket, you go, well, that's great, but I don't have that much to invest in those bonds, and then I'm not going to save that much, so I'm not really in the market for that. The fourth category of bonds to mention, and we've discussed these briefly before, are agency bonds, GSE, or agency bonds. They're normally called agency bonds, but we've talked about these government-sponsored enterprises, such as, does anybody remember a name? Fannie Mae. See, I didn't have to mention that, but I like to say Fannie Mae. So, Fannie Mae, Freddie Mac, Ginnie Mae, Sallie Mae, and so forth. These government-sponsored enterprises issue bonds, and you remember what they're doing with that. When they issue the bond, they get cash from the investors, and then they take that cash and buy, for example, mortgages. And they add liquidity to that mortgage market. So anyway, what I'm saying to you is, who's giving the money to those GSEs? Who's buying those bonds? Could be you, could be me. Could be the government of China. But I'll tell you, somebody that does it is the bank. The bank is saying, hey, we want some interest. The thinking is Fannie Mae, Freddie Mac are backed by the Treasury. That's the assumption. It's not written into law. Backed by the Treasury, so just as safe as buying a Treasury bond, but it pays a little bit more interest. And so rather than buying a Treasury note or bond, let's buy an agency note or bond. We get the same amount of safety, and yeah, we get an extra 0.25% of interest. Does a 0.25% mean much? Doesn't mean much if it's $100 you're lending. But if you start talking about millions of dollars, an extra 0.25% is decent. What's 1% of $1 million? $10,000. Right? And so if you could get a 0.25%, that's $2,500. Yeah, that's not a lot, $2,500. Well, what if it's 100 million we're talking about? Uh-oh. It's 100 times $2,500. And I don't even know what that number is. It's more like $1 trillion. No, I don't know what it is. Anyway, but I could do the calculation. 100 times 2,000 would be 200,000. Is that right? Yeah. So anyway, $250,000. So anyway, these are the types of things that bankers are investing in, not because they hate them, it's because these things don't pay as much as loans. And so bankers really don't want to get into this, but bankers do want to get the high interest. Final point for the day, since this is a residual, then what happens is, over time, we see banks are loaning more or less. Here's loans. And this is as a percent of their portfolio, their assets. And so what we find is this, is that when loan demand is strong and bankers are making a lot of loans, then not so many bonds. And then when loan demand is falling, let me do that. When loan demand is falling off and bankers aren't making so many loans, they've got more money to buy these bonds, and vice versa. So these things are moving in the opposite direction. Just that my pictures aren't the best. Okay, and so here's the bond portfolio that's going up and down in the opposite direction. If a banker says, oh, look, customers are coming in, they want to borrow a lot of money, let's sell our bonds off and make those loans. The loans are the best. And then when people aren't borrowing, we've got more funds, let's buy some bonds. That is what we'll stop with for today. This is the end of looking at the bank's portfolio of assets and liabilities. So long, have a good weekend.